Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Today I'm doing another SPAC investor presentation review. Haven't done one of these in a while. It's been a minute, mainly because SPACs have been kind of dead lately. Not a lot of good deals going public, not a lot of good valuations, not a lot of interesting companies really. When I was doing more of these, some of the valuations were interesting, some of the companies were interesting, at least the ones I talked about. But really, the latest and greatest in the SPAC world have been pump and dump schemes masquerading as short squeezes. In a way, potentially some short squeeze opportunity there, but really a lot of pump and dump schemes in my mind, and that's never good for investors in the long run. And yeah, you can make some short-term money if you're lucky enough to get on the pump and get out before the dump, but that's not what this channel is about. This is a long-term investment channel, and that's why we're talking about companies that I find interesting, like Polestar. This is an EV play that has been rumored to go public via GGPI, Agorez, SPAC. These guys are serial SPAC hunters. Agorez Guggenheim here. GGPI. It's up 2% before market, I think, pre-market rather. I think people were expecting a lot more from this one when it was announced. A lot of people got in expecting that sort of lucid pump, LCID, the stock that went from 10 to 50 down to 20, 25 or so now. If you kind of compare the valuations there, yeah, you can probably make the case that this is undervalued, but I don't know. Again, I just we'll look at the presentation. I'll talk about how I feel about the EV market, but I do think it's getting a bit overheated, and it has been a bit overheated. Even though I own Lucid, it's a $40 billion plus company that hasn't put a vehicle on the road. Even though I own Tesla, it's a almost $800 billion company that has pretty decent revenue and is growing at a decent clip, but the valuation is a bit out of hand. Now, Tesla certainly comes with some perks, like their solar business, their battery business that some of these other companies don't have or may not have. But it's still relatively expensive in my mind when you compare it to everything else in the market. And as I look at the market today, and I sort of talked about that in my last portfolio update video, things just seem expensive. And again, I'm a long-term investor, so I'm not selling. I'm not a short-term trader. I'm not taking profits or anything. Most of my money is in index funds. But at the end of the day, we've been in a bull market for basically 13 years. There was a little bit of a blip in 2020 that lasted all of 3 weeks, even though the world was going to end, and things are still kind of shitty in relation to how most people have to go about their day-to-day. And yet the market's back to all-time highs, and yet everything's amazing, and yet things are great, and multiples are crazy. So when you're in a market like that, sure, that can continue, but it does add additional risk to companies like Tesla, to companies like Lucid, to companies like Polestar, which are at the end of the day relatively speculative plays. Now, Tesla is certainly less speculative than Lucid, which is probably more speculative than Polestar because Polestar actually has some revenue. But when you're pricing these things to 20, 40 X billion dollars before they've made any sort of market share gains, then you're certainly in a spot where major losses can happen in the short term. But also on the other end of the scale, I'm sure you'll have a lot of people looking at the stock, and as we look at the financials, comparing it to something like Lucid and saying, well, this is X and this is Y, so this should be 2Y because Lucid is at X. And yeah, that's some in-depth analysis Twitter dude who's trying to pump this stock so he can get the hell out of there. But maybe from a long-term perspective, it won't really work out that way. So one thing I want to look at when I look at these SPACs, Gorez, this guy on Reddit, put together this little thing. It does have an error in it, so I fixed that with some PowerPoint amazingness. I mean, look at this thing. It's freaking great. This is actually $9.99. How has this SPAC sponsor done historically with some of these SPACs? Okay, there's some upside, there's some downside. In general, it's a pretty good record. The United Wholesale Mortgage being where it is and PAE Incorporated being where it is certainly a negative. But then you've got Matterport a company I love and own. I did a video on this a while back, and that was at $22. I haven't really been following it too closely, but hey, $22, I'll take it when I bought it at $10. Ardagh, which is, can makers, boring company, basically still around the SPAC price. Then you've got Hostess, Vera Mobility. Some of these boring companies do pretty well. If the tech is really good when it comes to SPACs, Matterport being one of them, it might do pretty well. Some of these boring companies like, Vera Mobility or Hostess Brands or, Utz, companies like that, they do pretty well. And then again, Luminar is another one of those tech plays. Now we're talking about another tech play in Polestar. So let's actually get to it and take a look at the presentation. I did look at the stock. Let's see where we are here and what the deal looks like. Introduction video. I did watch this. You might want to watch it if you're an investor. They do have some pretty neat technology. So if you're not familiar with Polestar, they're an EV automobile maker owned by Geely, I believe, which is a Chinese corporation, a privately held Chinese corporation that also owns Volvo and a couple of other car makers. They bought Volvo in 2010. Eventually, they spun off this Polestar brand, which is more of a luxury EV vehicle brand from Volvo and Geely, and are now spinning it off as a publicly traded company. This company itself is headquartered out of Sweden, Gothenburg, Sweden, and they make premium electric vehicles, essentially, right? They have vehicles on the road. They have revenue out there. They don't have too many vehicles in the United States or in Canada. They're more popular in Europe, but they are moving into the United States and Canada in a bigger way now. And this is probably a way to get that going and get some funds to get that going, because I'm sure this company is still burning cash like crazy and will continue to do so for a while. Business, so they've got a history of performance, etc. Founded as a racing company. They sold performance software to Volvo and worked with Volvo cars, and then eventually, were acquired by Volvo Car Group, which at that point was owned by Geely, that Chinese company that I mentioned before, and went to market. They launched two different vehicles, the Polestar 1, the Polestar 2, kind of focused on higher end products. Polestar 1, I believe, was in that 100K plus range, maybe even 150K plus range. Polestar 2 is a bit more affordable, in the 50 to 60K range. But again, they had a pretty good starting point in terms of, hey, Volvos are relatively solid cars. They have the infrastructure there. They have facilities they can work with within the Volvo parent company. And then they started with, small scale and then further expansion with a new facility that closed in 2019, the Polestar 2 being announced, then launched in 2020, and now they're scaling up with this IPO and cash generation. I haven't heard a lot about the Polestar brand or the vehicles that they have. I know that in 2020, after the cars were released, there were a couple of recalls. There's a few, I think there were like one or two actually in 2020. Polestar 2 recalled ... again. So anytime you're launching a new vehicle, might run into some issues. Probably not the most amazing sign, but again, it's going to happen to any company that's kind of just coming from nothing, right? And again, these guys aren't really coming from nothing, but anytime you launch a new car, a new vehicle, move into a new technology, and start to scale up, there might be some issues. So what are these guys? They're an established OEM and a startup, right? So that's kind of what they're saying that they are. We have this established parent heritage, I guess, from Volvo. We know how to make a car, and then we're also adding the agility and disruption that comes with the mindset of a startup, whether it's innovation, lack of bureaucracy, team chemistry, etc. They're global from day one. They're asset light, scalable, operational with global products and sales. They sold 10,000 vehicles in 2020. I believe they're closer to 30,000 in 2021. They are operating in 45 cities as far as their sales network goes. I believe they're direct like Tesla. They're in 10 markets across 3 continents, so a lot of room for expansion. They're mostly in Europe, China, United States, Canada, Asia Pacific in the future, Middle East in the future, etc. two award-winning cars. I have heard the car got good reviews. They look really cool. I've read that they drive really well. Again, they're going to talk about values, design, sustainability, but this is all the same stuff that you're going to hear in a lot of other EV players. And this is where I start worrying about some of this EV valuation that we're getting. And yes, you can certainly say Lucid is X. And, you know, we haven't gotten to the valuation here, but you might have read something. It's somewhere in the 20 billion range, which is higher than Lucid started. And these guys actually have revenue. And now Lucid is priced at 42 billion or something in that range. Still doesn't have any revenue. And yet this is getting a $20 billion valuation. So it's very easy to look at this and say, well, if that's valued at 42 billion, has no revenue, and this already has, you know, almost 30,000 vehicles sold in 21 alone, why is this at 20 billion? And we'll talk about that in a second, but maybe just both of them are overpriced. Maybe it's as simple as that, right? The technology might also be different. If you look at this, the Lucid car that they're announcing, the higher level version of that one, has a range of 520 miles or something in that range. And this Polestar 2 vehicle is in the 540 kilometer range, right? So that's almost half, basically half. So is there a technology gap that's driving that difference? Are people going to be more likely to buy a Lucid? Obviously, their revenue projections are where they are. If you look at the revenue projections from the Lucid video that I did, maybe they're a bit higher than this, and on a valuation basis based on, you know, some phantom 2025 sales, some of these valuations may make sense. But right now, this is what we're looking at. Polestar 1, 155K, started production in 2019, 2020 for Polestar 2, 50 to 60K. Again, you're talking about 120 kilometer range with their first vehicle. Not very good. You're talking about a slightly better range with the second one, but you're still far away from some of these 300, 400 to 500 mile ranges that you're getting with some of these other vehicles. Now, this is potentially the base model. I don't really know. Something to look into. They're targeting 290,000 vehicles sold by their 4 models in 2025. So seems like they can go to market pretty quickly. They had this one Polestar 1 in 2019. By 2020, they had another vehicle. They'll have a third one, a luxury SUV by 2022, then a premium sport SUV by 2023. And I think that's where the market's heading. You know, you've got Tesla working on an SUV. I know Lucid's working on an SUV. I know a lot of these other car companies are working on an SUV. So clearly a lot of money to be made with SUVs, and that's no surprise that a lot of places are moving into that space as their next margin grower. Then you've got some concept. Well, this is a cool looking car. Precept began as a manifesto of Polestar's future and is now becoming reality with Polestar 5. So you've got this 4-door luxury sport vehicle that's going to be out in 2024. And I mean, this thing looks pretty sweet. Split Thor's hammer headlights, long-range performance LiDAR, smart zone sensors suite, replaces legacy ICE grille and enables enhanced ADAS features. I mean, this thing looks futuristic. Looks like, what the hell is that car? DeLorean. Kind of looks like the DeLorean a little bit. So we're going back to what was cool and hip back in the 80s or whenever the car was around, maybe even the 70s, I don't remember. But it does look pretty cool. I mean, these guys are certainly tech-focused. They're certainly sleek. They're certainly going to prove that they're going to speak about, hey, we are technology-driven, et cetera, et cetera, et cetera. They're releasing the Sony PlayStation 4 here after the Sony PlayStation 3. So the Sony PlayStation 5 is clearly going to be even better, et cetera. You know, that's just what you have to be these days as a car company. That's the new norm. Ever since Tesla came out with their vehicles, this is what it is. It's technology driven, it's cool, it's hip, it's nice, it's performance, it's range, it's all of that stuff, right? You are not going to survive as an EV company if you don't follow Tesla's path, and clearly Lucid is doing that, focusing on premium performance and technology with high range, and these guys are doing that, kind of pointing out, hey, look at us, we've got sleek stuff and we've got a nice little big ass iPad in your car. Isn't that awesome? Well, every other car has that. Investment highlights. capitalizing on fastest growing market segments. They're one of the 2 global premium EV players already in mass production, so them and Tesla would be the 2. A startup culture with a focus on innovation, leveraging nearly 100 years of manufacturing expertise and leadership. They're an asset-light model with immediate operating leverage, digital-first, direct-to-customer approach, an attractive high-growth financial model. I mean, they sort of have to be to warrant this type of valuation. And they are an experienced and visionary management team. So rapidly expanding. This is in regards to the premium luxury electric vehicle market. And it's true, right? There's a big shift from regular cars to EV that's probably going to be more pronounced in the luxury space, because for me, EV is still sort of, in a way, or full EV at least, is still very much a luxury premium thing. Like, I don't own an electric vehicle. Just don't think I can afford one. I would have to put a charger in my garage. I'd probably want a battery thing in my garage that's charged by solar panels. And if I can get all that going, if I could afford all that, yeah, hell, why not? Let me get a EV vehicle. If I don't care that I may have to pay a bit extra to go out of my way to charge my vehicle, if I drive back and forth all the time, maybe I need range that wasn't really possible until today. So we're starting to get to a point where EV is getting realistic. I think we're still not at that point in terms of our infrastructure. I can get gas in my Subaru no problem at the 77 different gas stations around my house, but there's maybe 7 spots to charge my car, right? There aren't too many. And the one is like near a Red Robin or something, because that's where the Tesla charger seems to be, or there's a couple more at Whole Foods or whatever, but not much else that I know about, at least right now. And that really limits the amount of people that can get an electric vehicle at this point, which is why the premium and luxury space really is the space to focus on right now, because rich people are going to be rich and they're going to be buying stuff, right? And that's what this is showing. Hey, we're going to be growing, as this space rather is going to be growing at a 30% CAGR, pretty solid. It's going to be a 280 billion market in 2025, which is pretty good. But then you also look at all of these other companies focusing on this space, and it's like, well, that's not that amazing if this is the market space that 17 different companies are suddenly targeting, and you're maybe going to get 2 or 3% of that, right? So is the valuation really worth it? Something to consider. 29% growth is pretty good, but what valuation are you paying to get access to that market? These guys are addressing 80% of that market by 2025. They're in the fastest growing categories, including the PS4, the SUV premium, and they are in the fastest growing geographies, including China, EMEA, and eventually the Americas, which is probably growing a bit less than other markets because maybe it's a bit more mature. Where are these products going, and where do they project their sales to go? They started at 0 in 2019 when they launched their first car, so this is kind of where Lucid is right now. Moved to 10 million in 2020. By 2021, they had 29 million, so almost triple growth. They're more than doubling it, almost doubling it again, and then growing at a bit more of a reasonable space at that point. Again, with these SPACs, you always have to remember that these are very speculative plays, no matter what you look at, unless it's a more mature business, which some of these are. When you're talking about these newish businesses, newish technologies, quite speculative. This could be 29, 30, 32, 35, 39 if we have any sort of recession or something like that that's global in nature, and suddenly this $20 billion valuation means jack squat, because it's all based on these assumptions that may not come true. And you've already seen that, as if you're a SPAC investor, if you've followed the SPAC market, a lot of these stocks have gone from their $10 price point down to 5, 4, 3, 6, 7. I didn't count that in order, but you know what I'm saying. Certainly a good amount of stocks have done well, which is why SPACs are still an interesting and an intriguing proposition. But there is a lot of risk that comes to this, because all of this is based on assumptions that may or may not come true. And that's especially true when you're dealing with high growth, high volatility areas like EV. especially ones that are going to get more and more competitive as the market matures. So the only pure global EV play alongside Tesla, again, the comparison to Tesla, they're going to say, hey, our valuation is so much better than Tesla, somewhere down in the valuation metrics. Design, yes, we've as a company they've won multiple global awards. They're sustainable at the core, super amazing, fantastic, all good stuff. Soon they're going to talk about their other nonsense buzzwords that all of these things have. 603 horsepower. Is that really that amazing? I feel like some of these other cars, Lucid, whatever, are rocking 1,000 horsepower, but maybe I'm reading that wrong. I don't know enough about cars, so if you're a car guy, please feel free to correct me. But yeah, good technology here, state-of-the-art battery technology. So they have a developed 800-volt battery pack based on Volvo cars and Lotus technology. So it does seem like they have their own battery pack, which is good. They're not buying from some other company. That's one of the nice things about Lucid, one of the nice things about Tesla. A lot of the technology is internal, right? So they're not just dependent on some other company coming up with the brains of the operation. They're doing it themselves, which is very nice to see. Core in-house competence is well defined. They've got an R&D facility in various areas of the world. They're doing the preset architecture, the drivetrain, the battery pack, 2 different versions of the battery pack. Really, that's where I think the money's going to be made in this space. It's not who's making the best car, it's who's got the best battery, who's got the best motors, who's developing the best technology, and the battery is the technology of this space, right? That's the interesting part about this, that this industry is developing in a more integrated way than the current car industry that kind of, maybe gets batteries from somebody else. Ford's not necessarily developing their own batteries all the time, whereas Lucid and Polestar and Tesla seem like they are. And I think this is where the money is going to be made. Who's going to be most successful in developing the best batteries? And it might not even be any of these car companies, right? There's other corporations out there that are just battery focused, whatever they may be. And a lot of them actually went public via SPAC. They've got some autonomous driving partners, Luminar, NVIDIA, Waymo, Zensect, so they're clearly not working on their own autonomous driving technology, which is a bummer, but hey, there's going to be some partnerships there. Best of both worlds. You've got the light and scalable setup, the stability of established players, etc. One thing that worries me is that, again, at the end of the day, this company is owned by a Chinese megacorp, basically. And if you've kind of paid attention to what's going on over there, the government seems to be stepping in and kind of making sure that none of these companies get a bit too aggressive in what they think they can do, because at the end of the day, that type of stuff isn't amazingly awesome according to the government. So if the government suddenly says that, hey, maybe you guys have to do something different than what you're doing right now, that could be an issue, right? They're saying, hey, we're light and scalable, but that could also be a problem. Sure, it's a good thing because they don't have to invest all of these assets up front to develop these factories and raise their factory capacity, but they're also dependent on Geely and Volvo, because those are Geely and Volvo owned factories that they're using. And this is, I believe, the only one that is actually owned by Polestar, and it can only produce 750 cars per year, right? Everything else they're using, this is owned by Geely and Volvo. This is a potential production site that they haven't used yet. This is owned by Volvo. This is owned by Volvo. This is owned by Geely, and this is owned by Volvo and operated by Polestar, right? So again, Geely and Volvo are the same company. So Geely owns Polestar, and they probably retain a good majority of Polestar. But again, if the Chinese government ever steps in and says, hey, maybe you're giving this foreign company that is your subsidiary too good a deal on how you're renting them these factories or something like that, that could be an issue. I don't think it's a huge issue, but you have to kind of look at these things as like they don't actually fully own this, right? The company that owns them owns this, and they're sort of surviving on the behest of those companies, because if suddenly they can't use some of these factories, that is not on their balance, that are not on their balance sheet, then they have to invest a lot more money to become stable and alive. And yeah, they have access to global plants with almost 1 million capacity as a high return on capital, because they don't really have to invest a lot of capital in putting together their factories, which again could be a good thing, right? Because you're capitalizing on those synergies that exist within that partnership that they have with Geely. But it could also be a bad thing when you're dealing with a government that could potentially be as volatile to the businesses that exist within that country as the Chinese government, right? So they have a 3-year manufacturing reserve planning and reconfirmation. There's contracts that are evergreen, which means they should last forever and negotiate on a cost-plus basis. So overall, I'm not too worried about this, but something you have to keep in mind. But you can also see that the benefits that come with it, the capital intensity is a lot lower than some of the other players that may have to spend a lot of money on their own factories that aren't just, part of the Volvo parent brand or whatever. Yep, they have a nice app, very cool. Investment highlights, they have nice locations, very hip designs. Again, a lot of these plays, whether it's Tesla, whether it's Lucid, whether it's Polestar, kind of move in this, hey, we're like this cool, awesome, hip, well-designed brand, kind of like Apple, kind of like Tesla. That's really their secret sauce. But when that's your secret sauce and you're sharing that secret sauce with 63 other companies that are doing the same exact thing, in the long run, that could be a problem, right? And we'll see how that all works out. Current markets, they're in these 10 markets. They're expanding here soon. They're targeting 30 other markets, including Asia Pacific and Europe, further in Europe and the Middle East, with 150 plus locations and 800 plus service points. That's another thing I worry about when it comes to EV, whether it's Tesla, whether it's Lucid. When your car breaks down, when my car breaks down, when it's not an EV car, it's so easy to get it fixed. If you own a Honda, if you own a Subaru, if you own a Ford, or a very common car with a lot of service places around you, super easy to get it fixed. If my Tesla breaks down, I've read stories about people having to wait quite a while to get certain things fixed, to get certain things improved, etc. Might not be true, might become easier and easier as time progresses, but as more and more of these cars sell, they're going to need more and more service points across the board. And is that going to keep up with the demand for the cars? I mean, that's a good problem to have as a company if it doesn't, but it's not a good problem to have as a customer, because that could cause issues. So 29 million cars sold in 2021, estimated up to 290,000 in 2025. So you're talking about 1.6 billion in revenue, followed with an 83% CAGR up to 17.8 billion by 2025, which is kind of in line with what you saw in the Lucid presentation. And again, similar comparison you're going to hear. Lucid is at 42 billion. This is at 20 billion. If they're projecting the same revenue by 2025 or close to, and your starting point is higher here, is the upside here similar to Lucid? Maybe, maybe not. And then you've got an EBIT margin of 9% by 2025. Not amazing, a break-even EBIT by 2023. Revenue drivers, we kind of talked about this, rapid growth of that premium and luxury, existing geographical presence, a continuous and defined expansion of the sales network, and a strong car pipeline with additional cars coming by 2024. And you've got a team of Swedish-looking people. Got a financial overview here. 3 new models, 29,000 vehicles sold, 65,000 by 2022. Then you're starting to add the Polestar 3 and the Polestar 4 by 23. Then the 5 by 24. And you're not adding anything by 25, but you're talking about moving that market share of 0.2% up to 2.3% by 2025. Which is, again, not very unreasonable. They're starting small. They're growing at a decent clip. Maybe a bit optimistic. If that's the case, then who knows? But the thing that I worry about with this space and this space in general, not just with Polestar, is, are the valuations a bit optimistic? Because what is the end point here, right? We've got this whole car industry right now Ford, General Motors, Toyota, Honda, Volvo, Subaru, etc. I don't know the overall market cap of all of those companies, but if I just do Toyota, Honda, Ford, GM, Volvo, you're probably talking $400 billion in that space. I'm sure there's maybe double that, maybe a bit more overall in terms of market cap for some of these companies. And this is essentially all of the cars that are being made currently that are not electric vehicles. And the reason the market cap is so low, because cars in general are a very cyclical business, and they're not an amazing business model to be in, right? You've got relatively low margins. You're talking 2 to 4 to 5% margins, whether it's EBIT margins or whatever you want to look at. You've got price over sales metrics that are maybe in the 0.5 to 1x space because of that, because of the low margins, because of the high capital intensity, because of the high debt loads that some of these companies take, because of the fact that it's a cyclical business model and it's very up and down. If you look at Ford as a stock, has that been an amazing investment in the last 2 decades? Not really. It was a very good investment before the 2000 market crash. It kind of tanked after that. It was okay for a bit, tanked after that. It's been okay lately, but who knows what's going to happen next. And this is a company that churns out car after car after car after car, not just thousands of cars. They probably sell more cars in a month. Some of these companies probably sell more cars in a month than these guys are going to sell in 2024 altogether, right? On a best case scenario. And these are corporations that are valued at 40 to 50 billion. Toyota's probably closer to 200 billion because they sell a lot more cars. So what's the upside here, right? Is it full replacement of that space? Because those guys certainly aren't going away. They're just transitioning to EV. And while the margins here right now may seem like they could be 10% or higher, because that's what Tesla's achieving, maybe 13-14% margins right now, and these guys are aiming for 9 to 10% by 2025. Is that going to be realistic when by 2025 Ford is already producing a ton of electric vehicles, when Lucid's up and running, when Tesla's up and running in a big way, when Polestar's up and running in a big way? Or does this mean that eventually the level of competition that exists in this space, and I'm just not even, there's other players that are going to be out there as well, is that going to drive prices down in a way that makes this a lot more appealing to consumers, but also squeezes the margins of these companies, right? So if you're looking at something like 17.8 billion in revenue, now that's great, because your margins at that point are positive and your cash flow at that point is positive. But if those margins get tightened a little bit, that cash flow could become less and less impressive, right? You're talking about 20% gross margins by 2025. That's their optimistic projection. Right now, it's more like 9%. Why am I paying essentially, what am I paying here? 14x 2021 revenue for that? When I could get 50 to 60% margin businesses at probably less than that right now? Well, obviously the answer is, well, this is going to grow at 100% for 4 to 5 years and reach really impressive margin revenue levels by 2025. And you've got Tesla and you've got Lucid at these crazy valuations. So why shouldn't this be valued that way? And maybe that's fine. Maybe that's a realistic projection, and maybe all 3 of these companies can do well and really unseat some of these other legacy players. But maybe not, right? And maybe that bet from a long-term perspective is not one I'm willing to make as an investor, right? If I'm sitting here and looking at this, a lot of things have to go right for this to be priced attractively today in order for me to make a good return by 2025. And those things have to be, hey, margins have to improve and be much better than legacy car makers. Free cash flow has to be pretty good. Gross profit margins have to stay relatively steady, and they have to grow pretty quickly when it comes to their revenue. Now, the same argument applies to pretty much every electric car vehicle out there, and maybe this one's even less ridiculously priced than some of the other ones. but it's still a variety of assumptions that you have to get on board with. And those assumptions trouble me because I know that historically the car market sucks as a long-term investment. So if this is just another version of the car market, will it also suck as a long-term investment? You know, if vehicle makers are historically cyclical businesses, are we as investors, when it comes to buying Tesla, when it comes to buying NIO, when it comes to buying Polestar, when it comes to buying Lucid, are we buying at the top of the market? Because if there's a recession, if God forbid there's a market downturn, if inflation hits wallets more heavily, if bank rates, if the Fed raises rates, then these valuations will come down and come down in a big way, right? Because the valuations are built upon the assumption that these things will happen, that revenue will be, very, very, very good when it comes to growth, that margins will remain very solid in the face of increased competition. Right now, they're losing a boatload of money on the few cars they're producing, and Tesla's making an okay amount of money on the cars that they're producing. But Tesla's not really facing any competition right now, right? They're going to start facing competition in the form of Lucid, in the form of Polestar, in the form of a lot of other legacy players getting into the EV space, and those margins are going to shrink. Now, when it comes to Tesla, like I said, they have their solar space, they have their battery space, power walls, etc., all of that good stuff. Polestar, at the end of the day, is just a car maker, right? And yeah, they may also be a battery maker. They may also be more asset light than Tesla. They may also have some benefits to Tesla. But it's still, at the end of the day, a car maker. And I just don't know if I want to invest in a car maker when I'm looking 10 years out. Now, if I'm looking 6 months out, if I'm looking 12 months out, there's certainly an argument to be made that, hey, maybe GGPI in relation to Tesla, in relation to Lucid, is undervalued. Because if you look at some of these numbers, right, you're looking at very solid growth. You're looking at current revenue that's there, and you're looking at a market cap or an enterprise value that's 20 billion in relation to double that for Lucid, in relation to well above that for Tesla. So, if by 2024, if you look at Tesla's 2020 annual revenue of $31 billion, let's say by 2025, they're at 17, they're, let's say, half of that. Could this be a $300 billion company if the market multiples remain what they are, and if they can expand their margins to Tesla's levels, and if they can add some potential other areas to their business model? Maybe. So if you look at it from that perspective, you can say, wow, this is a relatively solid investment, right? But that all assumes that today's valuation of Tesla is reasonable. That all assumes that today's valuation of Lucid is reasonable. Now, again, from a short-term perspective, can this go from $10 to $20 in 6 months? Yeah. Like I said, there's going to be a lot of Twitter dudes pumping this thing up. There's going to be a lot of comparisons that are just very base level that say, hey, this is the multiple that you're paying for Lucid. This is the multiple for Polestar. Polestar's got a cool car as well. Why can't it go up to that level? And maybe that's enough to take it up. But who knows what that means from a long-term perspective. And for me, from a long-term perspective, there's a lot of unknowns that I'm worried about when it comes to investing a lot of money into this space, because I think in the long run, this space will eventually kind of trend towards that legacy space. And that legacy space isn't all that amazing an investment. And the other thing to remember is that this is a relatively small SPAC. This is 800 million. They're getting some pipe, but they're going to lose $1.6 billion in 2021, $1.2 billion in 2022, $0.4 billion in 2023. There's going to be more dilution down the line. They're going to take on debt. They're going to dilute, whatever. As an investor, you're getting a piece of the pie that you for sure know is going to dilute. When you look at Lucid, they got a big pipe, $2.5 billion. They got $2 billion in in cash from the SPAC. So they have a lot more cash to work with and burn through before they need to do that. And that's not to say that Lucid won't raise funds as soon, anytime soon, but they might be in a better spot from a balance sheet perspective. And again, these guys probably have less capex. They're a bit more asset light, so that benefits them, but still might be an issue. So you're talking about a $21 billion market cap. Most of that money is in terms of the rollover. Some of it goes towards the balance sheet, and then transaction expenses here. Interesting thing here is that this is a relatively small SPAC in relation to the valuation of the company, right? 94% of the money stays with the owners of the company. 94% of the company equity, rather, stays with the current owners of the company. Then you've got the sponsor getting a decent chunk. 3.8% goes towards us, the shareholders, if you own it. I actually don't own it right now. I don't know why I said us. And then the PIPE gets 1.2%. So like I said, they're getting 995 million in cash to the balance sheet. They're going to have 1.2 billion on the balance sheet right now, which means that they're going to burn through a bunch of cash in 21. This means that by 2022, they're probably going to be raising money somehow, whether it's more dilution in the form of new equity or debt. That's probably preferable in the long run, but who knows? Then there's also the warrants. This is a 1/5 warrant per unit, so not a lot of dilution there. You're talking about 1/5 of this, but still a little bit of something. And then there's some mention of earnout, which isn't mentioned anywhere else as far as I could tell. So that's something I'll have to look at the S1, and you should definitely look at the S1 for that. More nonsense here. Then we get to the valuation, and this is what I was talking about. Like, you can look at the global players, you can look at this valuation and say, well, this is a 3x. Lucid is a 6.5x. Can this go up to 20 in the short term? Yeah, totally. I think it can, right? And this is 2023 revenue, right? You're already starting at more than zero with Polestar. Lucid is starting at zero, right? So is it unreasonable to think that Polestar could go up to $20, even though the reaction right now is very muted? I don't think so. Lucid took a little bit of time to get going, and once it did, it really exploded. I think there is potential for short-term gains here, if that's what you're looking for. But again, remember, this is a speculative play. However, until the merger is consummated, if you have cash lying on the side, there's relative downside protection here. Let's look at what the stock is right now as the market opens. So it's up 2 to 2.5%, right? There isn't a ton of downside right now. If you buy a 1020, you're talking 2% downside. At the end of the day, if the merger falls through, you can always get your money back. If you don't like the deal at the end of the day, you can always get your money back. As long as you sell before the merger is consummated, you should be okay. And there's potential short-term upside, right? Now, I will say that this is still risky after that happens, because even though the valuations look good, I do think that some of these valuations are relatively optimistic. Like I said, Lucid hasn't made any money, and they're a $41 billion corporation. Tesla, is 20x sales or whatever they're priced at right now. And there's some tech companies priced at that level or above in terms of sales, but those are higher margin businesses as well. So that's where I worry with this industry. I do own Lucid. Like I said, I do own Tesla, but I own very small positions, and I actually sold Lucid when it ran up quite a bit. I might start a position in GGPI simply as a short-term speculative play. I do think there's some potential short-term upside in this space because it's hot, it's exciting, it's interesting. People will compare it to these big names that have been huge returners for people. Tesla was kind of a dud for a long, long time until it wasn't. Right? And this could be a dud for a while until it isn't. If there's hype, if there's upside, short-term upside in any space, then it's certainly in the EV space. You've seen that with some of the battery companies. You've seen that with Lucid. You could have bought CCIV, which was the SPAC for Lucid, for 10 to $15 for a while before it shot up to 50. Right? And I'm not saying that's going to happen with Polestar because the market's a lot different now than it was before, but it's not impossible. So if you're trying to take a short-term play, you could certainly do worse than something like this. Buy this at 1020, You have the downside of $10, assuming you sell before the deal is consummated, assuming you sell before you can get your $10 back. And there's potentially solid upside there. In the long run, and again, this is a long-term investing channel, I just don't know about this space. I wouldn't put all my money into this. A small, tiny percentage of my funds are in Lucid and Tesla, but I still think the valuations here are frothy. And I think from a long-term perspective, going from 20 billion to 200 or 300 billion is going to be tough, because I think the margins aren't going to be as good as the market thinks they will be, because I think competition is going to be there and the margins are going to get pushed down to where legacy car makers are. Maybe not that low, but at the end of the day, those companies are at, Ford and GM are maybe at 0.5x. So, is 3x reasonable based on 2023 revenue? Maybe, if we still think that margins by then are going to be much better than those legacy car makers. But if suddenly those margins are starting to get tightened because competition is getting more hardcore, then that could be an issue. And again, I'm comparing Ford, which is not a luxury brand, to Lucid and Polestar and Tesla, which are more luxury brands. But even some of those luxury brands in the car space aren't necessarily getting such amazing valuations, unless you're something like Ferrari or something like that. So if these guys are the next Ferrari, then yeah, maybe they're a really good bet, even on a long-term perspective. And again, a lot is baked into this. 78% growth for the next couple of years. Possible, sure, reasonable, maybe. Tesla certainly did it, but now they're slowing down. EBIT margins, we're talking about 9% by 2025. Tesla's in the 14 to 15% space. Lucid is even lower than that. Gross margins in that 20% space. Are these reasonable? That's where I worry. I think this is the biggest risk here. If these start getting tightened, these valuations will come down, even if the revenue growth is there. You're not going to get 4, 5, 6x valuations on these car makers if the margins are closer to the 2 to 5% range that you see from the historical players. So that's where I worry. Am I a long-term holder here? No. Am I potentially a short-term holder? Maybe. I think there's some upside here. The price didn't really move. I'll look at it more closely. I'll kind of look at the S1 to see what their earnout looks like. Do some more research on the cars themselves, and see what happens. Let me know what you guys think about Polestar. I do think it's an interesting company. I do think there's certainly a lot of winners. If you're an investor in the EV space in the last couple of years, you've been a big winner. Can that continue into the future? That's the big question mark. I think there's short-term potential there, especially when you look at something like Polestar, which is getting a decent valuation. I think when the rumor came out, it was closer to 30. Now it's actually 20. So certainly better for short-term investors. From a long-term perspective, decent risks there. But again, could really materialize if these guys can become a dominant player in the market, because it is going to be a market that's going to expand in the near term. And if for some reason they can maintain better margins than the legacy players, then there's space for a lot of these companies to do well. And Polestar is in a good spot. They're starting well. They're an asset-light model. The valuation is not ridiculous. It's not anything amazing, because I think a lot of these valuations are pretty optimistic based on assumptions, 4 or 5 years from now. But on a short-term perspective, yeah, I see why people would want to invest in this. I see why people are getting excited about it, and I will certainly take a look and maybe get a few shares here and there and let them sit, because I do have a bunch of cash on the side. And the upside here is pretty solid at today's price, assuming that I get out before the floor drops out, because some of these SPACs certainly get punished after that happens. If there's an earnings miss, if there's some issues, if there's another recall for Polestar, if something happens, if Lucid pushes back the release date of their car, if there's issues with their cars once they're on the road, a lot of risk from a long-term perspective. But with great risk comes great upside, so something to keep in mind. Not something I'd invest in with all my money, but a small portion of my funds may be allocated here in the future. Probably more on a short-term basis than a long-term basis until I do more research. As always, guys, thanks for watching. Remember, I'm not a qualified financial advisor. Please do your own research before investing in any stocks, including Polestar. Investing comes with risk of loss. Let me know what you guys think about Polestar or any of these EV plays. If you are all in or if you share the same concerns I do, let me know what else you guys want to see a video about, and I'll be back in the future with more. Thanks for watching. Leave a like, leave a thumbs up, which I also think is a like, subscribe, and all of that good stuff. Thanks.